This is Talk Business and Politics with Roby Brock.
Welcome to the program. I'm Roby Brock. Glad to have you with us. Well, in December, federal lawmakers along partisan lines passed a massive federal tax cut permanently at the corporate level and temporarily for individuals. The purpose of the tax cuts was to jumpstart the economy. 6 months later, we wonder, how are we doing? I sat down with Mervin Jebaraj. He is economist and director of the Center for Business and Economic Research at the Walton College of Business. We sat down right before Friday's 4.1% GDP reading. Mervin, it's been a little over 6 months, as I said, since those GOP tax cuts were passed. They were going to be used to increase worker salaries, capital investment and business expansion, and boost GDP to a robust 3 to 4%. And I would add it would also add nearly $1 trillion to the national debt. Let's go through each of these pieces one by one. First of all, are we seeing capital investment and business expansion?
So if you look at all the statistics that we have so far in the first 6 months of 2018 since the tax cuts were passed, some of the big picture items that you see, you look at corporate earnings, for example. We have a pretty decent picture of what the first 3 months of corporate earnings were in 2018. We're starting to get a better picture of what the second 3 months in 2018 were. But if you look at corporate earnings, they were up about 23 or so percent on a year-over-year basis just in the first quarter of 2018. Now, of course, this is the 110th month of economic expansion in the country, so that's contributing to a part of why the corporate earnings were up 23 or so percent. But some estimates indicate that about 43% of those earnings come from the corporate tax savings that you're seeing from the tax bill that passed at the end of 2017. So about a significant chunk of corporate America's earnings report in the first quarter, at least, came from those tax savings. And so you look across the various companies. With Home Depot, for example, you're looking at about 95% of its income growth came from tax savings. For a company like Apple, it was about 65% of its income growth came from tax savings. For something like Microsoft, it was about half. Google was about 26%. So varying percentages of how much their income growth came just from those tax savings. Now, obviously, the stock market is not going to respond very positively if most of your income growth came from tax savings as opposed to new business and selling more to customers. But it is important to show that a lot of corporate America has healthier balance sheets as a result of the tax savings that were passed through at the end of 2017. Now, on the flip side, are we seeing a whole lot of business investment? There is a lot of positive news here in the sense that business investment has gone up as a percentage of GDP in both the first and second quarter in the United States, at least in 2018. And it has been going up since about the mid part of last year, but it's moving up at a little bit of a quicker pace. So that piece is, as advertised, you expected to see some business investment growth in the United States, and you're starting to see a little bit of that happening. However, even though that business investment as a percentage of GDP has gone up in the past 2 quarters, it is still lower than where it was through most of 2015 and lower than the previous high in 2014, during which there were no tax cuts. So we still need to see a lot more improvements there. And I think there are a couple of reasons why you're still not seeing a whole lot of business investment, because if you think about when the tax cuts were passed at the end of 2017, and they went into effect for the calendar year 2018, so right now the tax savings that corporations are getting are based on investment decisions that they'd made in previous years, right? So this is rather a windfall of tax savings for them based on previous investment decisions. Now, if these businesses have great business ideas, business opportunities that they think they can profit from in the future, they will turn around and spend some of this windfall and get money from other places and spend it on new business investment. But what we've seen is companies, by and large, have spent about $700 billion in stock buybacks. That's a method of returning money to shareholders. And that $700 billion is just in the first 2 quarters of this year, so that's almost record levels of share buybacks through corporate America. Now that tells me that businesses are largely not seeing great future investment opportunities for them to invest their money in, so they're returning it back to shareholders. Now, I'm someone that doesn't think that all share buyback programs are bad. Obviously, they do contribute to issues around inequality that we have in this country, but in general, what share buybacks do is they take money from companies that don't see future investment returns or have good business ideas, return them to shareholders so shareholders can then invest them in companies that they might see better business opportunities from. So companies, the money would be going from older technology companies to newer technology companies and startups. And that part is actually good for the economy. That's the kind of flow of money that we want to see. The flip side of all of this, obviously, is that some of this tax savings should improve investment spending decisions at some point in the future, because the U.S. government will be taking a smaller chunk of your profits in the future. More investment decisions should be more profitable in the future. And if that is true for these companies, then you'll see some increases in investment spending. What we've seen is larger firms are projected to spend about 40 to 45% of larger firms have said that they will increase their investment spending in 2018 and 2019. But for smaller and mid-sized firms, that number is about 25% of them planning to increase their investment spending. And I think they're waiting for more certainty in tax policy to make sure that they will get as many tax cuts as advertised before they engage in more investment spending. So we hope to see a lot more investment spending than we have seen so far, at least to get us to the levels that we've been in 2014 and 2015 in investment spending in the United States.
And what has GDP, gross domestic product, what's the reaction been to the tax cut, and are the debt predictions coming true?
So the GDP reactions, the first quarter GDP grew about 2% the first 3 months of 2018, so that was rather tepid. What we're expecting in the second quarter anyway is stronger consumer growth and a little more business investment that we just talked about. And we're also going to see a little more GDP growth from exports, not because the trade wars are working, but because manufacturers in the United States are moving up their orders so they could get them out before the retaliatory tariffs hit. So we'll see a much stronger second quarter GDP growth than normal. But in general, what we've looked at various estimates, compared to last year when GDP grew about 2.3%, we're expecting about anywhere from 0.5 to 0.7% increase in GDP in 2018 as a result of these tax cuts. So that should get us to just under 3% or around 3% GDP growth. To pay for these tax cuts, we need to see sustained GDP growth over 3%. I think it's very likely, or it is possible, that we'll see 3% GDP growth this year, but it won't sustain through the next few years. And I think that's where you're seeing these projections of $1 trillion added to the debt over the 10-year period. We're looking at projections of $1 trillion deficit next year. In the short term, obviously that $1 trillion deficit next year is in large part because of the tax cuts that were passed, but the future deficits are probably in large part because of demographic changes and retirement payouts for Medicare and Social Security than anything else. So I don't think we're seeing the level of GDP growth, and I don't think we will see the level of GDP growth necessary to completely pay for these tax cuts, and we will probably add about $1 trillion to the debt when all is said and done.
And a big promise on those tax cuts was centered around those higher wages for workers. What do we see happening on the wage front?
So that's been the real disappointing story since the tax cuts passed. We haven't really seen any significant movement on the wage front. So right after the tax cuts passed, you saw a lot of announcements of bonuses. But at the end of the day, it doesn't seem like there were any more announcements of bonuses than usually happens at the end of the year. And none of these bonuses really contribute to, annual wage increases. So there are far fewer wage increase announcements than there were bonuses. And that's where you really see an increase in the average wages for workers across the United States. Now, if you're looking at the first quarter, the average workers' wages, when adjusted for inflation, actually went down. On a year-over-year basis from June 2017 to June 2018, there has been absolutely no change in the wages received by the average worker. And if you take into account the fact that they've been working longer hours, then there's actually been a decrease in average wages for the average worker. So you're not really seeing a significant increase in wages from these tax cuts. Now, this is part of a longer trend. The average wage hasn't gone up for workers in a very, very long time. The tax cuts were supposed to change that. We haven't seen any evidence of that yet. What we have seen is that consumers have gotten, some extra money in their pockets from tax savings, not from increased wages, but just fewer taxes taken out by the federal government. But in large part, unfortunately, those tax cuts are being eaten up by the gas price increase that also coincided during the same time. So you're not seeing a lot of extra consumer spending from all of this yet.
That's Mervin Jebaraj, Director of the Center for Business and Economic Research at the Walton College of Business. You can catch more of our interview online at talkbusiness.net.